for any time frame other than the one you're planning to make an execution on. So meaning if you're operating on 5 minutes, it must be 5 minutes, because right now you see I'm drawing, let me only draw the first layer. When I go to 1 hour, that line will no longer be at that angle. You see? You see, it is no longer at that angle. It is much steeper now. But if I would have drawn, let's say, for example, that line, and go to about a daily time frame, you will see that the angle changes. So like we could put it in a diagram that, okay, the more the time frame increases, the more the steepness of the line increases. Like when you change, like when you don't alter anything, and when you change your time frame, and like we vice versa after that. But like I won't advise anyone. There's no need to draw a line on 1 hour and go and still use that line while you're on a bigger time frame. That's why I don't like breakdowns of time frames where you analyze on daily, you analyze on, and after that you go to a lower time frame. But that when you're dealing with horizontal line, I would say, because like really there is no change. But when you're dealing with trend line and you see some alterations like this, it can be very, very disturbing, especially if you're dealing with an angle. But if you're just observing the market and just drawing the lines and letting the market react to that, to what you've drawn, that's a different case. So yeah. I hope I fully answered you, Mike.
Yeah, thank you, Brian. Thank you so much.
All right, no problem. So I think now we should move to the next one so that I can be able to answer your question. If you have a question, you can go ahead.
Brian?
Yes.
So just to add on to the context you've just explained, what happens in the situation where the lines are broken but the stock is just sitting between 20 and 80, for example, and the lines haven't crossed on the stock?
Okay, so the lines haven't crossed. Okay, try to make me understand like what kind of a situation you're talking about, when what is about to happen.
Okay, so if you look at the price itself, it's broken your first layer. But when you look at the stock is sitting between 20 and 80. So it's not necessarily in the oversold or overbought, and the lines haven't crossed. Because I remember in our one-on-one, when I asked you, you said the focus should be when the stock is on the oversold or in the overbought. But then what happens when it's the FL is broken, but the stock is sitting in the middle between 20 and 80?
I see.
The stock lines haven't crossed.
I see. So with regards to what you're saying, a footprint will form, a full setup footprint setup will form now, and after that you'll be able to draw your footprint line, and after that your first layer, and the market breaks your first layer, and when it retests, let's say you are on 1 hour, and on 1 hour you're not seeing anything. You're not seeing the market. It is, the stock is over the place. If you don't find direct divergence, it is fine. Go to a lower time frame, and on the current time frame you're in, where you did not find a fully convincing divergence, you will just confirm with only the crossing over because it is still the same thing. Because sometimes the market moves and it doesn't really need divergence. There's divergence everywhere technically because of different time frames. On all, there's no way like on 5, all of the time frames there can be no divergence. There's nothing like that. So let me show you the situation. Use this one. Can use this one first. So you can see how these lines move. And it only started to form a little bit of divergence when the market got, but like here, I want to show you on a smaller time frame that there was a divergence. There's no way. We'll check on 30 minutes. And after that, perfect. So on 30 minutes, can you see what was happening here? Let me delete this. In fact, I can be able to say, this is a point. We comprehend and we go up. That's a point. This is a point. That's a point. And it makes full sense. Are you with me, man?
Yeah.
And then from there it makes sense. So the major thing we must do is that be able to. It's not like when you have one option of just looking at only one time frame when it doesn't give you nothing. Just know how to like work with time frames because the same thing happens in all the time frames, but you must know how to comprehend everything going into a lower time frame, how the lower time frame forms the bigger time frame to be precise.
Okay. Thanks, Brian. I don't want to take up any more time. There's other people. Thank you.
All right. So I think after this meeting, I'm doing another one. After this meeting, I'm doing another one so that I answer more questions. No?
Cool. Thank you.
All right. Cheers. So, yeah, the third person can come in and shoot their question. And on the second meeting, I'll be able to answer it fully because we have about 3 minutes now. Well, what I can do is that in order to not have any, because you find that someone asked me a question here, but when I open up a new meeting, they are late on that meeting. So I'm stopping this meeting at 2 minutes and I'm starting a new one so that when I get a question from there, I effectively reply it and move to the next person. So I'm about to send a new link on WhatsApp. Stay tuned on WhatsApp right now.
You're an idiot.
Hello guys, welcome back. So yeah, without wasting any time, let's deal with the next person. If you have a question, like I've said, you will unmute yourself and throw your question.
So Brian, how's it?
Wonderful. How about you, man?
I'm okay, my brother. I would like to ask you about the indicator, the stochastic indicator. So between two lines, the blue one and the red one, use the D line and the K line. So in order to get the confirmation of the divergence, so which line are we drawing on top of? Is it the red line or the blue line to get the right divergence?
All right. So you're not drawing any line on a stochastic. You just simply wait for the stochastic, for those two lines to cross each other. And when they cross each other, depending on whether they're crossing to the downside or they're crossing to the upside. When they're crossing to the downside, the blue line will come from the top to break the orange line. The blue line will come from the top to break the orange line. And it is even the same case below when the blue line, it is the one that also comes to break the orange line also on the downside. So you just quickly wait for the blue line to do the magic and to cross the other line, because these are just like moving average, but in a form of here they're given range in terms of overbought and oversold. They are moving average, but inside the stochastic oscillator.
So that means the blue line is the power line, is the powerful line.
It is, yeah, it is the one that hints us lack of the crossing over.
Okay. The other thing, when coming to the chart, you'll find sometimes in order to get to draw the line, the divergence line, you will find that between the first point and the second point, you'll find there's a long candlestick between them, and it kind of like disturb the divergence. So do we draw the line on the end of the stick or just on the candle, on the entrance or the exit of the candle?
We draw at the tip. The reason why we draw at the tip is that we don't want the situation, because if we draw at the body, meaning like at the body, it's like you determine that using what is this, the line chart. We don't do that. What we do is that we confirm with the tip, meaning, let me show an example. Meaning when we draw a line, if we drew using the body, we would have drawn something like this, and we'll leave out all these things. And now when this is the case, if we use this method to draw a first layer line, you find a situation where the market that is the first layer line is broken, but it is a false breakout. And that way or the breakout will not like happen very effectively when it should actually happen, because of your line, it is not drawn to represent the actual footprint of the market, where the market actually turned, because these weeks they show where the actual market went. The market once came here. This weeks they show that the market once came here, so you cannot ignore them.
Okay.
Yeah.
Okay. The last one, when coming to search for the footprint on the chart, maybe you go through the chart. So is the best way, is it let's say I found the footprint on 1 hour. So so the other ones, the 30 minutes, 15 minutes ones, I have to ignore them and go to the 1 minute for the divergence and for the entry and the divergence for the re-entries. So those ones I must forget and watch on the where I spotted, let's say 1 hour, and go to 1 minute for the re-entries.
No. So like it doesn't really matter. Just like I've said, each and every time frame have its own divergences. Yeah. So now when that's the case, you find a situation where okay, you can go to a lower time frame like 1 minute. But like when you go there, it helps when the market it is like has the highest momentum. When you're expecting a highest momentum, which you can expect it when you see a divergence where you see that all the time frames they're giving you the same divergence that touches your overbought or oversold almost at the same time, meaning your 1 hour, 30 minutes and 15 minutes. They're giving you divergence at the same time. There's no other that is where you're finding just only the crossover where the stock is. It has no ties to overbought or oversold. Yes, clear divergence everywhere. That's when okay, you can expect the momentum, and from there you can do that. But if you're not expecting any big momentum, what you can do is that in order to avoid, because you find that sometimes you go into a lower time frame and you're on fine, you got the direction, but you're adding too much trades based on 1 minute. Fine, the market consolidates and even that 1 minute consolidates. So if there is no much momentum on that 1 minute, you'll find yourself being taken out because of you will go all out on 1 minute and you will not accommodate the retracements that will be happening as you continue to be in profit. So I wouldn't say like ignore them and go to a lower time frame. But the thing that the less time frame you go to, the more you'll be able to spot divergence early. It is true, but you must do that in a very smart way. Where you expect a very good momentum, you must utilize that effectively. And where you're not expecting any big momentum, just like a regular divergence where the market moves into your direction, but in a consolidating manner, you can focus on like even 2 time frames below. It doesn't have to be like 1 minute, 1 minute, 1 minute. So that like you make sense of the structures that will be happening, the sizes and everything. Does that make sense, man? Hello, who
Yeah,
was it? Okay.
yeah, I'm saying yeah, it does make a sense. Thank you very much.
Okay, no problem. Okay.
Tada, sure.
Let's see the next one.
Hello.
Hello.
Yes.
Hello.
Hello. Good evening.
How are you?
Very well. My name is Mabel. This is my
All
first
right.
time here.
All right. This is your first time. Where are you from, Mabel?
Nigeria.
All right. So yeah, right now we're just dealing with the questions. If you don't understand everything, it's fine. I will start breaking out the strategy for you guys after I'm done with a few more questions. Yeah?
Okay. That would be awesome. Thank you.
No problem. Thank you. Let's take the last one and be able to chop up the strategy so that the new ones can adjust to what we're doing here. All right, I'm not seeing anyone. So, but like, yes, fine. Let me go ahead and break down everything. Yeah. So here, what guys we're dealing, especially the new ones, we're dealing with a strategy that we call the MMC footprint strategy. This strategy, it is applicable on all the time frames. It is applicable on all the assets, meaning you can trade NASDAQ with it, you can trade volatility index with it, you can trade currencies with it, you can trade stocks with it, and you can operate on all the time frames because it's just the same thing happening over and over again in different sizes. Yeah? So with this strategy, we use as an indicator that it is called a stochastic oscillator, and we don't change any settings with regards to the stochastic oscillator. We just leave the settings as 533, right? The reason why we do that, we leave them as 533 is because of majority of people around the world find especially the new ones, find the settings as much as that, like unchanged. So we want to use the same settings, but when we operate in a very opposite way, because of we know that majority of people lose money. And now when you have a MetaTrader 4 platform that is set in a certain way or in a particular way, you must be able to do the opposite in order for you to profit. Unless if it is working for you in a certain method, but in our case, we use the total opposite of what is actually is given to us. So now, and bear in mind, we use stochastic only for entry purposes, but just to analyze, this is what we do. So I'm going to share a whiteboard and explain to you what we're looking for every time we're about to analyze any chart. So we look for where the market gives us this structure, and this is a sell structure, the buy structure. So now what is happening here? Now what is happening here? The lines that we draw, the first line, it is connecting the first 2 points. That line, it is called the footprint line. And mainly like this line, its function, it is just to show the slope of where the market it is trending to. And the second line that I'm about to draw, which is the most important line, I'm gonna use a different color. This line that is called the first layer line. And this line, it helps us to distinguish if the market will continue going down or the market will break and go to the opposite direction. If it will continue down, it won't even touch this thing. There's our footprint. But if it is anticipating to go into the opposite direction, you'll see by it breaking. After it breaks, as we know that the market doesn't move in a straight line, it will eventually retest. As it retests, that's when the stochastic comes into play, so that we can be able to start executing now. So from there, what we're going to do is plot divergence between this point and that point. And I want to show you how that it is done, or how the divergence is spotted. As you guys can see the settings here, you see 533 here. So the divergence, you spot 2 points, and the current point, the point you'll be at, it must give you something like this. So I want to show you an example with 2 points. Fine, when the market was here, the stochastic was here. When the market, sorry, when the stochastic was there, the market was there. So you can see the total opposite of what is actually happening. From here to there, and then from here to there. But in this case, the market, the stochastic has hit the overbought. After the overbought that is hit, we confirm our buy with the crossing over here. The crossing over between those 2 lines. And immediately after those 2 lines, they cross. That's when we start executing for a buy. Okay. And yeah, take it from there. Buy there. And the market will favor us. So the same technique that I just showed, you're going to be using it between these 2 points, and you'll be taking your buy here. If I take a buy, the market will go into your direction. It will retest as it continues to go into your profit. As it retests, you'll be between this point and that point. You can spot more divergences so that you can spot like another divergence so that you can continue buying it. And then from there you can buy it. And when you must know actually when to actually close this trade, and we determine when you should actually close this trade by drawing the same setup again, drawing your footprint line first. And after that, drawing the first layer line. After you draw the first layer line, you simply wait for what? For the market to break. And immediately after it breaks, because like what I've told you that as we wait for the market to normally break the first layer, it is signaling that it is the market that is about to go into the opposite direction. Now, the market was trending up. Now it is breaking the first layer, meaning we expect it to go to the opposite direction. So meaning we cannot keep on holding on the buys that we took, because now we're expecting the sells to come into place, but we're expecting the sells after the breaking of the first layer. So now what we do, we close all the buys and wait for the market to do what? To make a retest and give us a divergence opportunity for what? For a sell. After we take our sell, we do the same thing. As the market keeps on going down, using divergence, we add trades using divergence. And after that, in order to know when to actually close with the sells, what we're going to do is that we're going to draw our lines again. And what do we do from there? Wait for the market to break there. So what is actually happening here is that you have access to the market going up, going down, going up, going down. Guys, give me a quick second. Quick. I'm coming back now. All right, guys. So yeah, that's what is actually happening. To take our profits, we just simply wait for the market to break the first layer. Then from there, we know when to actually pull out. And when you have this, like I've said, you have an opportunity to hit the market going down, going up, going down. Even if the market can consolidate, you can still, even it doesn't matter how it consolidate, or you can still understand what is actually happening. So now I want to, let's go to currencies now. Oh, before that, let's just check what is the gold trade that we took. All right. So I analyzed with you guys this gold. And from there, I think we're supposed to, this line was supposed to extend it until here. And from there, we saw an opportunity to buy here. Yeah, was it there? Yeah, I think it was here. And since from there, this thing has responded very well. Because if we can be able to determine when you should actually pull out of this trade, it'll be very easy because the structure is very easy to look at. So even if it goes up like crazy, even if it goes up like crazy to here, when it starts to consolidate, you will understand that, okay, and it breaks the first layer. That's when you know, okay, this thing is about to go into the opposite direction. So yeah, just simply wait for it to break the first layer. Then after that, I just wait for a pullback and spot my divergence and be able to execute on a sell and do the opposite from there. So, and even in the most detailed form, meaning on smallest time frame, 1 minute, the same thing it is happening. From here, we'll just buy. Just few minutes ago, we could have just simply took a buy on this thing because of you saw your footprint, you saw your first layer. After the first layer gets broken, after the first layer gets broken, you spot for the first divergence. So now the first divergence in this trade, as we're on 1 minute, actually here it is inclined, it's not horizontal. Yeah, from this point to that point, it is descending. The line that we drew is descending. And after that, from this point to that point, it is ascending. Sorry, and from there, what we're going to do is just wait for the crossing over that will happen down there. And from there, you guys can see. You will execute your buy and you put your stop loss at around there. So without adding any trades, without even any leverage, look at, re-entries. I want to calculate how much you will make. This is very good. You make about 665% without any trades. So now, tell me, if you use divergence and add more trades in between, where you keep on when the market is going into your direction, you will tell me if you have $100, how much will you be having in if you have a 10,000, how much you'll be having by when the market gets there. So just simple practicality. And I want to show you something. Even if the small movement that is happening, it is because of footprint. Footprint is everywhere, guys. You guys can see from there what is actually happening. So what is going to happen now is that you guys will go and practice, especially those of you who are new, practice and send results in the group. And guys will engage you guys in a group where they'll be giving you hints on top, or like with regards to whether you are drawing is wrong or right, because there's no way you will learn if you're not practically active and showing us any results in the group. Because of if you're doing something wrong, you have to be corrected. That's the only way you can learn. And from there, it will be very beneficial to engage with guys in a group, ask as many questions as you can. They are very, 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 very good guys who are willing to give you hints on a lot of things with regards to the strategy. And what we normally deal with is footprint throughout. There's no need to mix this strategy with another strategy, because what you're going to do is that you'll put yourself in what we call a cycle of doom, moving from one strategy to another, but you don't know what you're doing. You don't know why you're doing that. You're just moving from one strategy to another, and there are no results that you bring to the table, and there's no leverage that you're achieving with that. So the advice is not to mix this thing with any other thing, so that like it doesn't waste your time, because of the danger of mixing strategies. That let's say you are on the buy on this trade, your strategy is saying sell, footprint is saying buy, and whereas you have another strategy saying sell. Now, which one are you going with? Now you'll end up like being frustrated over something that you could have solved by dealing with one way of working, and it will reduce all your problems. So here yeah, there's nothing more. If you practice, there are guys who practice like a lot of times. Now you guys can see them. They're sending nice results in the group because of they've seen like the footprint, the potential of footprint, and how it can bring leverage, and how many opportunities are you exposed to on the market. Because there are thousands and thousands of opportunities, if not millions, on different time. Imagine how many divergences or how many footprints happen on 1 minute, on all the time frames of all the assets that are available from, in the financial markets, from currencies to indices to stocks, futures, everything. And you go to also 5 minutes of those assets, 15 minutes of those assets, spotting the footprints on each and every, on daily basis, how many footprints are being formed. So there's a lot, guys. You can't count them. You can't count them. So the more you practice, the practice it is just to make your mind practically active, and to increase also your confidence and knowledge. And you must know what you're doing, and you must not hesitate when you want to execute a trade, because when you hesitate, that means something is wrong. You need to go back to a drawing board, and you need to have confidence, and that confidence will only come when you have been exposed to those opportunities with your naked eyes. When you've explored about 1,000 footprints on all the time frames, next time you see a footprint, you know what will probably happen, and you won't be as frustrated as like when you just placing the trade and you just wait for it for a first time. It won't happen that way, because of your practice, and you saw 1,000 opportunities where the market went into your direction, and between where you've actually entered and where you've actually closed, you could calculate, okay, how much money you could have made while you're leveraging with just all those movements. It will end up driving you crazy, because of these opportunities are infinite. The market, it is built this way. And don't think here this is a strategy. It's not a strategy. I don't regard it as a strategy. I regard it as a perspective, a way of viewing the market. So yeah, that's it, guys. So for now, let's go and practice. We'll start working tomorrow. We'll be at the office chopping up the one-on-ones. Still haven't forgotten about you guys. So we'll still compiling a new list that I'll be tackling. So I'll contact you guys privately. Like I've said, the goal is for this week to end with all of you guys sorted out in terms of one-on-ones. So, but yeah, nonetheless, good night, guys.